Hello and welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this video, we'll discuss the corporate earnings season and what it means for your portfolio. As earnings season ramps up, markets are shifting their focus from geopolitical concerns to tangible evidence of how businesses are performing. With the stock market hovering near all-time highs, questions around profitability, valuations, and the sustainability of recent trends have become increasingly important. While this is still early in reporting season, current Wall Street forecasts suggest this could be another strong quarter, with the S&P 500 earnings per share reaching a new record level. Over the next few minutes, we'll explore three key areas. First, let's talk about how strong earnings growth supports portfolios. Corporate earnings are what connect the stock market to the economy and ultimately to portfolios. When economists analyze GDP growth, the job market, or consumer spending, these factors affect investors through their impact on corporate profits. This is because a healthy economy usually leads to improved sales and earnings for companies, just as we've experienced over the past few years. As you can see in this chart, the stock market tends to follow the path of earnings over long periods of time. The fact that the US economy is vibrant and has grown steadily is perhaps the most important reason for the long-term rise of the stock market. So far, about 13% of S&P 500 companies have reported their results for the fourth quarter, and 75% have beaten earnings expectations. At the moment, earnings per share are expected to grow by 8.2% across S&P 500 companies, which would represent the 10th consecutive quarter of earnings growth. When looking at the full year, earnings grew by 13% and could grow by around 15% in both 2026 and 2027, according to estimates. These are well above the historical average growth rate of 7.7%. If these trends continue, they would represent healthy growth rates that support portfolios. Now let's turn to valuations and why they matter during earnings season. If earnings are the long-term driver of stock market returns, then valuations are a shorter-term gauge of whether the stock market is under or overvalued. For instance, the price-to-earnings ratio tells us how much investors are willing to pay for each dollar of corporate earnings. Today, the price-to-earnings ratio for the S&P 500 stands at 22.2 times earnings, well above the historical average of 15.9 times. While this is high, it's backed by healthy earnings growth, unlike during periods such as the dot-com boom when investors ignored profitability. Here's an interesting way to think about this. The price of the S&P 500 index rose 16.4% last year. If earnings per share grew 13% over the full year, then it was by far the largest driver of growth. Specifically, earnings contributed about 80% of the price return, whereas the increase in valuations contributed about 20%. For long-term investors, this means that portfolios have done pretty well, primarily because companies have performed better and not because investors have been willing to pay more for stocks. That said, high valuations carry an important implication even if earnings growth remains strong. When stock prices reflect optimistic expectations about future earnings, there's often less margin for error, leading to larger market swings during periods of uncertainty. Finally, let's discuss how AI investment continues to drive capital spending. It's no secret that companies are investing heavily in the infrastructure needed to support AI applications. This massive capital investment is reshaping not just the technology sector, but the broader economy as well. As you can see in this chart, earnings growth expectations vary widely across sectors, with the highest earnings growth expectations in the information technology sector. For investors, this trend has multiple implications. Companies making these investments are betting on the continued growth in AI adoption. However, if adoption disappoints or takes longer than expected, companies may face pressure on profit margins. The key point is that these trends are difficult to predict. While quarterly results are important, the full impact of AI on productivity and economic growth will take years to materialize. So, the bottom line is that strong corporate earnings have helped to support the stock market and portfolios. With ongoing uncertainty and high valuations, it remains important to focus on balancing portfolios to manage risk while staying on track to achieve financial goals. We hope you found these insights helpful. If you would like to learn more about any of these topics or discuss how they relate to your specific situation, please don't hesitate to reach out. We look forward to speaking with you.